Good morning, everyone. Welcome to the class where we are discussing the previous year VTU questions. And in this class, we are going to do the numericals for the topic called exponential moving average. Okay, so when we talk about technical analysis is all about analyzing the historical data for the past performance of the company, closing price, and the volume, and with that, trying to predict the future change or try to predict the future momentum in the market. That is what we try to do through technical analysis. When we talk about technical analysis, in order to work on the technical analysis, there are a lot of tools are there. You can talk about RSI, you talk about MFI, you talk about ADX, you talk about stochastic oscillator, William dot percentage, R, MACD. So then working on moving averages, you have tools like parabolic SAR. You have tools basically working on simple moving average, exponential moving average. You have envelopes. You have Bollinger Bands. So we have so many tools whenever we want to analyze the data based upon the past performance of the closing price of the stock with respect to their highest, lowest, opening, closing price. And then probably when we want to detailed graphical representation, we can use candlestick diagram also. So already I have made video candlestick model. I have talked about the content related to the technical analysis. So whenever you feel, you can go through my videos on technical analysis to understand the theoretical perspective of technical analysis, how technical analysis is different from fundamental analysis. Okay, so going further, when we talk about VTU exam perspective for the subject called investment management, specifically, VTU ask questions either based on RSI, relative strength index, or either based on exponential moving average. Okay, so RSI only consider the closing price of the stock, and based upon the closing price of the stock, we calculate the RSI value between 0 to 100. It is basically oscillator which gives a value between 0 to 100, and based upon the value what we get in RSI, based upon that, we try to figure out where the stock lies, either in overbought region or either in oversold region. And with that, we try to predict the scenario that we should we buy the stock or should we sell the stock. So right now, my perspective of discussion is not to talk on RSI. Right now, I want to focus on something which is more important, that is called exponential moving average. Okay, so when we talk about average, what is basically average? Average basically generalize the data. Whenever we say average, average basically generalize the data. And whenever we talk about averages, average can be simple moving average, average can be simple moving average, or average can be exponential moving average, or your average can be exponential moving average. Average can be simple moving average, or it can be exponential moving average. So when we talk about simple moving average, in case of simple moving average, we give equal weightage to all the event which has happened in the past. Okay, and the formula of simple moving average is basically the sum of data divided by the number of data. That is the simple moving average. That is basically sum of data divided by the number of data. When we talk about exponential moving average, in case of exponential moving average, we don't give equal weightage to the all the historical event which has happened in the past. We give more weightage to the event which has happened just now, then to the event which has happened before, then to the event which happened before, then to the event happened before. So the formula for the today exponential moving average is equal to today closing price, that is equal to the today closing price into today exponential moving average. Formula is today closing price into smoothing constant. Okay, then plus smoothing constant we normally represent with a symbol called K. So plus yesterday exponential moving average plus yesterday exponential moving average into 1 minus k. Okay. Now what is smoothing constant? So what is smoothing constant? So basically, your smoothing constant have a formula called 2 divided by n plus 1. So whichever n day exponential moving average you want to determine, so you can find the smoothing constant with the formula called 2 divided by n plus 1. Now you can see this question. You can see this question. Uh, Yeah, so you can see this question, which came in, you can see this question. This question came in VTU 2000. This question came in VTU 2000. Okay, January 2000 question paper. This question came in VTU January 2000 question paper. You can see this form question. Okay, so they're given you some days. They're given you some days. You can see this. Some days are given to you. So this is the question. So you can see the question number 5C. So you have to calculate the 5 day exponential moving average for the following data. You have to calculate the 5 day exponential moving average for the following data. So they have given you 10 days closing price of the stock. So that is given to you. So you can see this. You have 10-day closing price stock is given to you. Once the 10-day closing price of stock is given to you, you can find the smoothing constant. So you can find the smoothing constant. So how will you find the smoothing constant? To find the smoothing constant, you want 5 day exponential moving average, right? You want five. You see this in the problem. You want 5 day exponential moving average. You wanted 5 day exponential moving average. So find the smoothing constant for find the smoothing constant. So smoothing constant formula is 2 divided by n plus 1. So you want 5 day exponential moving average. So n here would be 5. So 2 divided by 5 plus 1. This would be 2 divided by 6. This would be 1 divided by 3. This would be 0.333. This is your smoothing constant. Okay, everyone. So the same thing I've done here. You want 5 day, no? So you want 5 days. So you can write smoothing constant 2 divided by, you want 5 day, right? So 5 plus 1. So you want 5 day exponent. So this is the smoothing constant. Okay, that would be 0.333. It's a recurring decimal. Now what you need to do, so first thing what you should do, first determine the 5 day simple moving average. First thing, determine 5 day simple moving average. How to determine the 5 day simple moving average? Very simple. uh, do the sum 5 day simple moving average. What is the formula for 5 day simple moving average? So the formula for the 5 day simple moving average formula is very simple. It is 95 plus 100 plus 120 plus 130 plus 96 divided by 5. That is 5 day simple moving average. I hope you are getting the logic. First, find the 5 day simple moving average. This is for the first day. For second day, if you want, then for the second day, if you want the 5 day simple moving average. For the second day, the 5 day simple moving average, that would be 100 plus 120 plus 130 plus 96 plus 98 divided by 5. I hope you are getting the logic. Then for the third day, Then for the third day, simple moving average, that would be 120 plus 130 plus 96 plus 98 plus 100 divide by 5. So do this, guys. Everyone, please do this. Find the simple moving average for every day. I hope everyone got the logic. So for the first 5 day, you will take the data of the first 5 day. Okay. Then after that, you will take the data of the next 5 day. Then you'll take the data of the next 5 day. Then you'll take the data of next 5 day. Then you'll take the data of next 5 day. I hope you're getting the logic. Find the average of that. Find the average of that, everyone. Find the average of that. So this would be the 5 day simple moving average. So the 10th one, what would be the data? This would be 140 plus 120 plus 160 plus 100 plus 98 divide by 5. Clear, everyone? I don't think so anyone have doubt on this. Very simple. Then once you get the 5 day simple moving average, then we want to find the 5 day exponential moving average. We want to find the 5 day exponential moving average. So for the 5 day exponential moving average, you have to use this formula. You have to use this formula. This is the formula. Okay, this is the formula what you need to use. So now if you understand in this formula, if you understand in this formula for the first day, if you understand for the first day, there's no yesterday exponential moving average. So for the first day, please understand. So please understand whenever we are calculating the exponential moving average, whenever we are calculating exponential moving average of the stock. Okay, so for the first day, okay, take the take a simple moving average as the today exponential moving average, because for the first day you cannot do anything, because for the first day there's no yesterday moving average data. Okay, for the first day, so take the that day simple moving average as the exponential moving average. Okay, everyone. Okay, then for the next day you can use a formula, that is today closing price into smoothing constant plus yesterday exponential moving average into 1 minus smoothing constant. So you can do this. And this you can determine for all the days later on. Clear, no, everyone? So for the first day, you simply take today simple moving average. For the second day, what you do, you take 98, which is your closing price, into smoothing constant plus yesterday moving average, that was 108.2 into 1 minus 0.3. Clear, everyone? So I hope you understood this. Now, similarly, we'll do the problem for which came in January 2018. This problem which came in January 2018. Question number third, C. Again, similar kind of problem. Again, you have to find the 5-day only. Again, you have to do the same 5-day exponential moving average calculation only. So logic remain the same. Okay, everyone. So logic remain the same. So same way, this closing price into smoothing constant plus yesterday exponential moving average into 1 minus smoothing constant. Everyone, please write it down. Anyone have any doubt, ask me. Do this calculation, same logic, do this calculation. So I hope you have understood everything what we have done in this class. So with that intention, I like to say thank you to all of you. So see you all in next class. Till then, take care of yourself and keep practicing the problems on investment management. Thank you, everyone.